Hi, everybody, and welcome to PowerCast. I'm your host, Tyler Mathisen, and in this new podcast, we will explore how emerging technologies, notably artificial intelligence, can help make us all better investors. I know I could sure use the help. Now, each episode of PowerCast will show how people and technology can collaborate to create better investment outcomes. And that's true whether you're in charge of multi-billion-dollar portfolios or something far, far humbler. The common thread, the key here, is great data insights that only AI can provide, and we're here to deliver them. Now, we're taping our inaugural episode today on the 17th of September. To put it mildly, it has been a year of incredible flux, and for U.S. stocks, risk-defying returns. U.S. equities are up around 12% year to date, 30% since that April swoon triggered by trade turmoil. Some, but by no means all, of that trade turmoil has abated. But there are plenty of other risks to process. Conflict in Ukraine and Gaza, the continuing collision and competition, fierce, between the U.S. and China, and ongoing uncertainty about the path of interest rates globally in the U.S. and about the independence of the U.S. Federal Reserve. It's enough to make your head spin, so let's get right into it. We've got a great episode for you today. We're going to talk with Liam Bogen. Liam is chief executive of Quantmatics, a Dublin-based AI-powered trading platform, and he's going to tell us about his platform's highest conviction signals right now. And if you want to know whether to buy or sell or hold, Liam is your guy. We're also going to get the view from Wall Street. We'll talk with Mona Mathisen, head of investment strategy at Edward Jones, and we'll talk with Christian McCormick, head of client portfolio management at Makita Capital. It advises institutional investors on asset allocation and model portfolios. We begin with Liam Bogen. Liam, welcome to PowerCast. It's great to have you here.
Thank you very much for having me. It's a pleasure to be here.
Of course. Let's start by, in layman's terms, describing what Quantmatics is, what it does, what its value proposition is, and how it can help investors like me or like a big institutional investor.
So Quantmatics is basically an AI solution to help investors make better timed investment decisions, to generate ideas, to help people identify single stocks or opportunities, to be able to monitor the risks in their portfolios. What essentially it is, it works like market GPS, right? So it's not magic. We're not predicting. We are generating slow-moving scores, statistically very significant signals. We cover the entire universe of investable instruments, and we see loads of signals at the same time, which allows you to have much more higher confidence in any decision that you're going to make.
So you're looking at things that have happened in the past or are happening today, and then running them through an AI engine to kind of forecast what's going to come up, right?
Essentially, yeah. Once you get the signal, that that the instrument will accelerate in the new direction and will continue to do so, depending on the time frame that you're looking at.
So if I were to create a metaphor, you're looking at things that are happening way out in the ocean, right? You're picking up signals, you're processing those things, you're running them through various models, and then you feel confident that those signals that you have picked up are going to lead to some kind of event or outcome in the market. Some days, some weeks hence.
Yes. I mean, in a way, we've spent a lot of time trying to describe this ourselves. So we've learned to describe it basically like a market seismometer, right? So an event happens in the ocean, and then you get to see the impact of that later, right? But we get to detect the moment at which the event occurs.
Two questions. I sense that what's happening here is sort of you're looking at what's going on out on the top of the ocean, and then you're making a call on what you expect to happen. Have you back-tested these models so that you know that what you are looking at is going to lead to the kind of outcome that you are predicting?
Yeah, I mean, we realized very early on in this project that in order to build trust with users, we had to backtest absolutely everything, right? So we've got a comprehensive data science team, we've got significant backtests, and actually we have our own live trading fund which now trades the signals, right? Mm-hmm. And so we've got like backtests that go back for 20 years.
So when you make, let's call it a call, a prediction that something's going to happen, and we're going to get to that in just a minute. With what level of confidence do you make that call? Is it a 75% level of confidence, a 90% level of confidence, a 50%? Or do you tell me as a subscriber to your service or a user of your service, okay, this one's a 50% probability, this one's a 90% probability?
For every signal that we have on every instrument every day, if we get a signal, we generate price targets, like a target 1 and a target 2. So it's a kind of a trading target price. It's a 10 period, either 10 day, 10 weeks, 10 months target price. So that target price is generated using the individual volatility characteristics of the instrument, and so we provide you with a hit rate, right? with a target, a hit rate, and a stop loss for every instrument across the world.
Explain to me how what you do is different from, if it's different at all, from market timing, which is something that most investors say cannot be done persistently, consistently, successfully.
And that's a fair question, right? So and we are saying we have a market timing tool, right? So, but what we are explicitly saying is that we have tested extensively our proposition. So we have, so there are time periods. So effectively, our daily signals, sort of the duration between a green and a red signal, as in positive and negative signal, be 10 days. It tends to be 10 weeks on our weekly signal and 10 months, roughly, on our monthly signal. So we can see that trends persist over time. Essentially, what we're trying to do is capture trends moving over time, changing direction of the trend, and capturing the volatility around that trend with our trading plan.
And so, if I boil it down, what I think you're saying is that using the technology that we have, which includes artificial intelligence, a breakthrough kind of data analytic tool,
yeah.
that we are going to rewrite the rules of investing so that we can say there are market timing tools that can work.
Yes. I mean, that's exactly why we're here. We're here to say that, yes.
And so time will tell, and we will have you back repeatedly to see whether you're right or you're not right.
Exactly, yeah, and I look forward to that.
So let's get to where we are right now today and what those signals that are deep in the ocean that you've been watching over the past couple of months, what are those signals telling you today about U.S. equities or global equities? What's your call here?
So we actually got a large cluster of early warning signals. So we've got an early warning signal, kind of like a market exhaustion signal. They occurred at the end of July, beginning of August. We had like hundreds of signals across the world. And we have been sort of watching the progression of this now all the way through to September, right? So where we see ourselves in terms of our market GPS is that we see particularly the S&P and the Nasdaq and all of the US indices, they're right at the very top of their trading bands.
They are at records or very close to it.
So they're at record highs. We are seeing a real dichotomy in terms of the scores between in the markets, right? So it's kind of like right now, and it's a very interesting day right now with the Fed decision coming up, but we're kind of like right at the point of the fulcrum, right? So we've got like 50-50 positive, negative. Obviously, the big weighted tech stocks are what's driving the market higher because they've got heavier weighting under the hood of the market. We can see a very interesting picture emerging. And
what is that picture? And this is based on signals that your models have been picking up and analyzing from as far back as July.
Yes, exactly. Yeah. So what we're seeing the market to be in actually a very positive state right now, but in its state of approaching exhaustion. Right? Exhaustion. So we've got like more and more stocks are actually starting to just, generate a red triangle on our system like exit signals. The fund that we have live, that can be leveraged, and it trades our highest conviction signals in a systematic way. Right? So and I have to say I was a bit nervous about this myself, as we went into the end of July when we got that very large cluster of signals, the fund itself was actually nearly 300% exposed to the market, right? So nearly close to its maximum
And now
leverage.
it is.
And now it has, one by one, these stocks have kind of rolled over. So we're now less than 50% exposed to the market. And that's been done systematically, right? So one by one, all of the stocks that were in the fund have generated their own exit signal. So we're not saying it's going to like absolutely collapse, but they're just rolling over now.
Rolling over, and the
vulnerable
consequence of that might be a decline in the major broad market indexes in the United States on the order of what?
At the bottom of our trading bands now is about 7%, 7 to 10%, possibly. But that would be potentially a healthy pullback. But it kind of needs to happen, I suspect, here. Right?
So your high conviction trade in U.S. domestic equities right now is for a pullback on the order of 7% over the next several weeks.
Potentially, yes.
Potentially, yes. Are there segments within the market where you have similar high conviction trades, either positively or negatively?
Well, what we're seeing is very interesting right now is that we are seeing a definite negativity in the U.S. consumer stocks. Right? They're definitely continuing to roll over earlier.
So when you say a consumer stock, you're talking about a consumer staple like a Procter & Gamble?
We're seeing more of the consumer discretionary stocks, right? You know, so particularly the likes of like DraftKings, Norwegian Cruise Lines.
So we've got your thoughts on U.S. equities, broadly speaking, a couple of sectors there. Let's look at global equities, and particularly China. Chinese stocks may be defying the common view, have been doing pretty well lately. What do you see?
Our system is bullish of Chinese and emerging market equities, and particularly the dollar. As we've been seeing consistent, and even over the last couple of days and llast night, further negative signals in the dollar.
I was going to ask about the dollar later. What do you see there since you raised it?
We're seeing the dollar weakening and continue to weaken. I mean, it has had several failed attempts to turn around. We've got fresh series of negative signals, and that's driving bullish signals in emerging markets in China.
Let's move on to fixed income. What do you see happening there? What do your models say?
Our model is showing U.S. yields falling, but actually we're seeing them hitting like support levels, right? So like 4% in the 10-year, maybe 3.95 might be the bottom of that, right? But the whole curve, 2-year, 5-year, 10-year, 30-year, yields are falling across the board, right? Which has been really interesting. So we're not seeing any turn here in terms of like yields rising. So the market's buying into yields.
So that's
falling,
a bullish sign.
So that's a bullish sign.
That's a bullish sign that bonds are going to be more valuable, even
may
though
not have much more lower.
Even though your interest on those bonds may go down.
Yes, yeah, exactly. But it's showing, that there may not be more downside in terms of the yields may not fall that much more, but there definitely doesn't look like they're rising.
Tell me about gold.
Gold has been an extraordinary performer, right?
Yes.
So our system has been very bullish on gold. We had a negative signal in gold back in April, right? It didn't fall very far, but it kind of went sideways, right? But recently we've got positive signals, and gold is now, it looks a bit too stretched right now, right? So it doesn't look like our system is broadly bullish, but in terms of our system and our trading bands, it's outside the top of the trading bands. So it wouldn't be surprised if it fell back a little bit within an overall bullish trend.
Final thought will be on crypto. I feel like Rip Van Winkle. I didn't know how strongly Bitcoin has been performing. What do your signals say there?
Again, our signals have been very bullish, right? So our scores are very high, but they're looking a bit exhausted at this stage, right? So we're seeing the scores sort of easing, but it's certainly not generating sell signals, right? So it looks like after such a huge run, the market is, it looks like it's ripe for a little bit of profit taking.
A little bit of softening.
A little bit of softening, but again, nothing terribly significant.
So the idea here is that you're going to come back and join us the next time we do this, and we will replay, or at least go back and look at exactly what you have said here by way of maintaining accountability, and we'll see whether what your models have said have turned out to be true, turned out to be partly true, or not worked. We'll find out the next time. I know also that you all are offering, Quantmatics is offering a coupon or a discount for people who want to take advantage of the data and information that you offer. Tell us about that.
We're delighted to be here to talk to you today, right? Yeah. So for anybody who's watching the podcast, we decided that we'd have a special discount code. It's called NEW50, NEW50, right? If you log onto our system, so you go to quantmatics.com, take a free trial, and just insert the code. You'll get a 50% discount.
Liam Bogen of Quantmatics, thank you so much for being with us.
Thank you very much for having me.
Great. With us now is Mona Mathisen, Head of Investment Strategy at Edward D. Jones. Mona, it is great to have you with us. We now know what the Fed's interest rate course is likely to be for the remainder of this year and into 2026, maybe even 2027. Are they on the right course?
Thank you, Tyler, and so great to be with you as well. Look, we know the Fed is caught between a rock and a hard place. We know inflation is elevated above the 2% target, and we know the labor market has shown signs of softening. Now, where the Fed has really turned to now is that labor market weakness. And what we've been seeing is not only job gains that have been cooling, unemployment rate that has been ticking higher, but we've heard Jerome Powell, both at Jackson Hole and the recent press conference, reiterate that there is a real risk that the labor market could deteriorate more rapidly than they'd like to see. So the Fed would like to get ahead of that. We think they are on the right course, 25 basis point rate cut in September, followed by gradual rate cutting, perhaps heading to that 3.5% neutral rate. Now, historically, the Fed likes to be about 100 basis points or 1 percentage point above the inflation rate. That's where they like to take their Fed funds rate. If we think the inflation rate is headed towards that 2% target, or even in that 2.5% to 3% range, we think the direction of travel is still the right path for the Fed. That 3.5% neutral rate makes a lot of sense to us. And by the way, I will also add, if the Fed is cutting rates, which we think they will, in a backdrop where we are not in a recession or entering a recessionary environment, which we think also is the backdrop, markets tend to do well with that environment.
So I take it you would agree with the idea that the interest rate path we're on is more of a risk management path than the kind of rate cutting path that you would see if the Fed felt the economy was in imminent danger of something more serious.
Yeah, I think that's well said, Tyler. So I think Jerome Powell himself noted this is a risk management rate cut, which means the Fed is really trying to bring the Fed funds rate down to a neutral level. So then they have some flexibility if they do need to lower rates or raise rates down the road if the backdrop shifts. So we think it's a prudent way to get to neutral here, and we think we'll continue to see a gradual move lower.
So this is kind of a land the plane safely sort of move. Let's pivot then to what individual investors might look forward to over the next several months and what they might do in their portfolios. What's the portfolio check that they should be doing now?
Yeah, absolutely. You know, in an environment where the Fed is cutting rates, we think there's two backdrops happening here. One is that cyclical environment. So as rates are moving lower, we do tend to see a broadening of market leadership. That means asset classes like not only large cap stocks, but mid cap and small cap stocks can play some catch up. That means not only kind of those tech AI names leading the charge, you could see a broadening of leadership beyond tech and AI, including cyclical and value sectors. But I should also add, there is a secular theme that is permeating this kind of cyclical environment that we're seeing. And that, of course, is we are in the secular bull market on AI and technology. And I think that is an environment where investors have to be cognizant. We want exposure to tech parts of the market. As we go through this Fed rate cutting cycle, we'll probably see some form of catch up, but we want to make sure we're also following the earnings picture. Thus far, technology and AI have led the earnings story. We expect that to broaden over the next 1 to 3 years as rates move lower. So diversification remains the name of the game, but that includes technology and non-technology parts of the market.
It sounds to me like you are not of a mind to advise people to take profits even after the market has risen about 30% from its mid-April lows that were driven by the tariff worries, the tariff turmoil. So you're not really expecting this to be a time when I should take profits or that there's likely to be a market pullback.
Yeah, you know, it's a good point. We have risen 30% plus in the S&P 500 since those April 8th lows. Any given year, we expect 1 to 3 pullbacks. We had a pretty severe pullback back in April, about a 20% or near 20% decline in the S&P 500. We are headed towards an environment where, you know, the labor market may be softening. We're in September and October, historically more volatile months in the market. We could potentially see some market volatility or at least a digestion of these tremendous gains. But what we'd say is that pullback, that volatility can be used as opportunities for investors, especially as we look towards 2026. That's an environment where not only interest rates may be lower, we have a tax bill, by the way, that is in place and should start to kick in and provide some fiscal stimulus, especially for those companies that need CapEx or R&D spending. And we also have potentially a more clear tariff environment, which could lead to elevated earnings growth as well. So we look towards 2026 in a favorable way. We would use any volatility to kind of take advantage of that.
Mona, I'm going to ask you to sit tight as we bring in our next guest, and then we're going to come back with you and mix it up in a kind of round robin. Joining us now is Christian McCormick. He is head of client portfolio management at Makita Capital. Well, Christian, let me jump right in. One of the things that is very interesting to me is the increasing interest that lots of investors, whether they are institutional investors or individual investors, have in the private markets, private equity, private debt, and private infrastructure. To what do you attribute that?
Well, thanks, Tyler. And it's a great question. So I think it's important to divide the market into two segments there. So if we look at traditionally institutional investors, so referring there to, say, large pension funds, Taft-Hartleys, endowments, foundations, even large multifamily or single family offices certainly fall into that category. They've been big proponents, or I should say big participants in private markets for an extended period of time, several decades for most of them. And that's been across the board, but primarily focused on private real estate and private equity. Private credit has entered the mix with some momentum in the last 10 to 15 years, we would argue. But actually, private infrastructure has been somewhat underallocated, even on the institutional side, which I can go into later. But on the private wealth side, so think financial advisors, think retail investors, say, especially within 401ks, with the recent changing of regulations around the allowance of private markets in 401k plans, which still has a long runway to actually be fleshed out. That there you see relatively new allocations to private markets, and they see the same things that these institutional investors have seen, which is higher returns, lower risk, certainly a diversification benefit because of a mismatch in how these markets react to the same type of macro factors versus, say, public fixed income or public equity. And so we're seeing a greater participation in each of those private market asset classes. And we think that's very sensible. And in light of what we saw last week with the Federal Reserve policy, we now think that the interest rate path is going to be more favorable to probably larger allocations into those markets.
Well, I was going to ask you that because I wonder, as we spend and focus our time on the here and now, what's happening today and maybe over the next 3 months, the private markets, whether it's private equity, private infrastructure, or the bond trade, those things are long-term holdings. So does the fact that the Fed has told us we're probably going to cut 2 more times this year after the cut last week, do those markets react to the Fed the way, for example, the public equity, the public debt markets would react?
If we look at, say, private credit, for example, if the interest rate path is clearly on a descent down, or that's what the Fed has hinted, they've kind of reset the path a bit, we would argue, a lot of those securities are floating rate securities. So those floating rates are now going to set lower. When we think of a asset class, like private infrastructure, what's really the driver of an infrastructure project? It's how you're discounting those future cash flows. So now you have a lower discount rate, which can help sustain valuations. But in addition to that, you also hopefully have a lower cost of capital, all else being equal, depending on what inflation does in the various sectors and supply chain bottlenecks. But overall, your cost of capital should be lower, which should help to facilitate higher returns, hopefully, just because your construction costs and other associated costs aren't quite as high as they once were before the rate policy was set lower.
You know, Christian, I had heard of private equity. I had heard of private fixed income or private bond. I hadn't heard of private infrastructure. What kinds of investments are we talking about there? And are there places in that big sphere of private infrastructure investment that are overcrowded trades right now versus sort of not undiscovered, but maybe undervalued trades? Walk us through that a little bit.
It's useful to think of infrastructure as just necessity or a necessary asset is probably a better way to phrase it. High barriers to entry. These are in traditional categories such as transportation, power generation, logistics, think toll roads, think bridges, think airports. But if you go back to around the global financial crisis, really 2 categories that dominated were transportation type assets and also what we would argue would be power assets, traditional power generation or utility assets as well. And you maybe had 100 to 200 billion in annual transaction value. Now you flash forward to today, we're up to about 800 to 900 billion of transaction value. So that gives you an idea that in terms of the deal value and the number of deals and the robustness of those deals, that has certainly picked up. But we've also seen a whole host of new category entrants come in, renewable technologies, battery storage, digital infrastructure, which would be data centers, which I'll touch on in a moment, things like 5G towers, fiber, right? So it's a broad array of assets. And one other positive of these that kind of came into, I would say, was fleshed out a little bit better around 2022 when inflation became a problem is many of these assets have some sort of inflation protection built in. So it's either a direct tie to CPI or perhaps just an automatic annual price increase or a step up. And if it's going to be a stagflationary environment or even a high inflationary environment, that makes these assets very attractive from a defensive perspective. But in terms of looking at maybe some overcrowded areas, we certainly are somewhat wary about the US data center buildup. There's certainly a lot of great investment opportunities. The dollar amounts that you see from Meta, from Microsoft, from OpenAI, from Oracle recently, of the amount being spent on these data centers really to facilitate the AI secular theme that Mona referred to are quite remarkable. But we still see a lot of danger areas there with there's a difference between how fast, say, a data center itself can be built and connecting the transmission line to it, meaning these data centers require a tremendous amount of power, and maybe I can build a data center in 3 to 4 years, but because of regulatory backlog and other supply chain bottlenecks, it may take 6 or 7 years to actually attach a major transmission line to it, which creates a mismatch in terms of the timing. So we think that area may have been a little bit overcrowded or may have become a little bit overcrowded in the US, but overall on infrastructure, we're still very, very bullish.
All right, Christian, I'm going to bring Mona back into the conversation. You stick around because we're going to talk back and forth a little bit here. And Mona, why don't I pick up with where Christian left off? There is a tremendous amount of discussion about the building of data centers. What do you tell your clients, your customers, your force of financial advisors about investing in companies or investing in data centers?
Yeah, absolutely. And look, we certainly have seen the AI infrastructure and AI technology trend play out in an interesting way. Of course, it has started with the semiconductor building block infrastructure players of AI, and that includes data centers, that includes a lot of the large Mag 7 players that you have alluded to here. But over time, we would expect a lot of the market gains and a lot of the productivity gains to ultimately go to the sectors that benefit from the AI technology itself. So over time, we would expect sectors like, for example, healthcare, which could do great with robotic surgeries or with ERM systems, infrastructure and industrials in particular that look at manufacturing facilities, financial services, a sector that we're very familiar with as well. All of those are examples of sectors that could benefit from, over time, this AI build out. And so we are hopeful that the gains that we are seeing today kind of go from the big tech AI names to the broader sectors, and that kind of fits in with that broadening of market leadership theme as well.
So Mona, and I'm going to ask Christian you the same question. I kind of know, Mona, what your answer is going to be here. Our first guest today, Liam Bogen, said that Quantmatic's models are sort of forecasting a 7 to 10% pullback in equities, U.S. equities, over the next short period of time. It seems you disagree with that. He basically is looking at signals that are telling their AI analyzers that the market is looking a little tired. Agree, disagree?
Yeah, look, I think we could be aligned there as well. We talked about how 30% run in the S&P 500. We wouldn't expect markets to continue to move up indefinitely. We know along the way there are pullbacks. Perhaps it's even a sell the news reaction after what we saw in the Fed last week. Perhaps, as we talked about, seasonality comes into play, or perhaps we just have to digest a period of a cooler labor market and cooler economic data. So 7 to 10% pullback to us seems reasonable. And in fact, a lot of participants are sitting on the sideline waiting for markets to pull back so they can get more involved. And as we talked about, we do see a case for 2026 re-accelerating. And so we want to get in ahead of that as well.
Christian, same question to you. What's your reaction to Liam's prediction of a 7 to 10% pullback in U.S. equities? I know this may be a little bit off your farm, so to speak, but give me your thoughts anyway.
Well, it's interesting, and I would actually echo a lot of what Mona said. So, I mean, when you look at equity markets, like I've always loved the rubber band theory, right? You have, some great, market participants such as Cliff Asness and others that have done some fantastic work on trying to tie valuations to future market behavior. But it's pretty remarkable how much that rubber band can be stretched before snapping back. And so, even though valuations are certainly elevated, we would think that would probably increase the probability that you could see a pullback. We think that's reasonable. But perhaps maybe a slightly different tact is when you look at Liam's position is when we think of AI. So moving back to this broader secular theme of AI, we at Makita are certainly big believers that AI is going to have profound effects in a positive way on future revenue streams, on workplace productivity, on just the way that work streams function internally at a company. But when we think about asset management, right, there's really three main prongs that we look at. So one is, and we've already addressed it a little bit on the infrastructure side, which is what are the main themes or areas of investment that are positive for this AI secular theme that I, as an asset manager, hopefully with my clients, can participate in directly. But then the second one is, how are asset managers actually changing what they do based on improvements in AI technology? And we think Liam is a great example of that. Is traditionally, if you do, say, bottom-up stock picking analysis, or you have a traditional quant approach, what AI has created is pretty creative and interesting and innovative ways to either augment what you already do in trying to pick the direction of the market, say, or maybe even outright replace it. So the third prong would be the power of disruption. And this actually speaks directly to what Mona mentioned, which is key, really the beneficiaries of it beyond AI infrastructure. Think healthcare, think banking, but, keeping an eye on how AI can swoop in, and this applies to a public company, also applies to a private company, and disrupt what you thought was perhaps a longer term technology, what you thought was a safe revenue stream. We saw this a little bit earlier in the markets with SaaS, right? Software companies where there was a worry that AI could come in and disrupt their models, kind of broadly speaking, and we'll see if that plays out. But that power of disruption really being that third prong of the other two that I mentioned that we are focused on with AI and asset management. But Liam and his approach are a great example of the second prong of that.
Christian, very quickly, which will do better, the markets or the Denver Broncos? I can see you're a Broncos fan.
Well, if we have the pullback, then I'll go ahead and say the Broncos, but I'm going to hedge my bets there and probably say the market has a little bit more positivity going for it than the Broncos do.
Christian, thank you very much. Christian McCormick, Head of Client Portfolio Management at Makita Capital. Mona Mathisen of Edward Jones, thank you as well.
Thank you.
Thanks, Tyler.
Now I'm going to kick it over to my friend Mark in a segment we could have called A Man and His Dog, but we've labeled it The Zeitgeist.
Hi, I'm Mark Egan of Montclair Media. I'm here with our brand ambassador, Luna. I want to talk about two stories today. We've heard from our guests about how to trade everything from equities to bonds and even crypto. But apparently, at least according to the Wall Street Journal, maybe we've been investing in all the wrong things. You might think the stock market's where it's at. You might be forgiven for thinking it's all about the Magnificent Seven technology stocks. You'd be wrong. Pokemon cards. That's where it's at. Pokemon cards have gained more than 3,800 in value since 2004. That's according to Card Ladder, which tracks trading card values. By comparison, the S&P 500 has done quite well. It's only gained 483% over the same period. Meta, the owner of Facebook and Instagram, has climbed a paltry 1,844% since going public in 2012. Pokemon cards, much better. I announced this here as news, but my youngest daughter has been telling me for years that Pokemon are where it's at when it comes to investing. I guess I should have listened. And speaking about youth, there's been plenty written recently about why Gen Z is struggling to fit in at the office. I was taken on one interesting perspective recently from Fortune magazine from Scale AI co-founder Lucy Goh, 30 years of age, the youngest self-made billionaire, and she suggests that Gen Z workers who are unhappy at work may simply be in the wrong job. She says if you feel the need to clock off at 5 p.m., maybe you're in the wrong job altogether. She had a killer quote, I would say that if you feel the need for work-life balance, maybe you're not in the right work. Gao's among those younger workers advocating for the Chinese 996 model of work, working from 9 a.m. in the morning to 9 p.m. at night, 6 days a week, Luna. 6 days a week in order to get ahead. It's a fascinating idea. I think we can all agree. It's not going to work for me. Back to you, Tyler.
Mark, thank you very much. Now, I don't know about that 996 stuff, but I'll tell you one thing, it's not happening here. I am so far beyond that. Well, this brings us to the end of the initial edition of the PowerCast, and we want to thank you for joining us today. I want to thank also our guests Liam, Mona, and Christian for being with us today. Next time, we will have Liam back and hold him accountable for his picks. Meantime, I'm Tyler Mathisen. May you be healthy and wealthy, and we'll see you on the next PowerCast.